On this Melbourne Cup Tuesday in November, the Reserve Board met and they've kept the cash rate on hold at 0.75 of 1%. That's on the back of stable unemployment. So we haven't seen unemployment deteriorate. In fact, it improved. More about that later. And also some commentary coming out of the Reserve Bank in regards to some signs of growth in the economy. So they're gentle, very subtle signs, but ultimately there are still signs there. So let's take a look at what did transpire through the course of last month and what data that did show up. Let's start with a global story first, and obviously the US economy. So last month we saw the Fed Reserve cut the cash rate by another 25 basis points, and that brings their cash rate down to 1.5 to 1.75. It's the third, and I would suspect possibly the last rate cut that we're going to see from the Fed Reserve, unless the whole China deal crashes, the US-China trade deal. More about that in a minute, because the economy is going pretty strongly. Just some indications there. So unemployment was higher than expected in October. That was also on the back of revised data coming out in August and September. So their unemployment rate currently sits at 3.6%. So very, very low. They do have an increasing participation rate, and that was why it moved up from 3.5 up to 3.6% during that time. The US consumer remains positive. Spending, equity markets are looking good. The US bond yield curve is going back to a more normal setting, so there's no real dangers there that we're seeing showing up there. And obviously the biggest news story was in regards to a US-China trade deal, phase one they're calling it. We obviously saw that announced, and now we're sort of seeing that agreement potentially being signed this month. So what does that mean is what I've always said it was going to mean. They've done their hard negotiating, the US. They've got a position. Now they obviously need their economy and the global economy to start picking up because they've got an election. Well, Trump has got an election to win come next November, so that's going to give that enough time to flow through to the economy. So phase one of the deal to be done, and that should also see global sentiment improve. In fact, we did see at the G20 summit last month that the commentary around the global economy was looking to improve. That's a good sign on the back of this US trade deal. We did see in China, they recorded upbeat manufacturing sentiment as well, potentially on the back of that. So the only other problem child we've got at the moment in terms of the developed nations is the UK, and they're going to the polls next month to work out what they're going to do in their general election, and obviously for Brexit. What I did want to talk about is I've got the IMF global forecast for 2020 for all the big nations around the world. So we're sort of seeing global growth in the United States easing from currently 2.3% in 2019 to 1.9%. The Euro area was 1.6 going down to 1.5. Germany 1.2 in 2019, staying stable at 1.2 in 2020's forecast. France 1.3 2019, growing by 0.01% to 1.4. Italy 0.5 currently this forecast for this year, growing to 0.9 of 1%. Spain 2.1% growth this year, slowing down to 1.9. Japan 0.2 last year to 1.4%. United Kingdom 1.2 to 1.6. Canada 1.8 to 1.7. Russia 2% down to 1%. And the other ones that I really wanted to focus in on were China, currently growing at 6.1%, easing to 5.9%, and India growing very rapidly at 7.7% this year, also growing at 7.1% next year. And then developing Asia, which is going to be a big story over the course of the next decade also for Australia, grew at around 6.3%, will grow at around 6.1%. So putting that in context, we're talking about the Australian economy growing at over 2%. And so, we're still growing better than some of these other larger, more developed nations. Let's turn our attention now to the Australian economic news and what we see here, the inflation data I wanted to start with. So trimmed mean inflation, which is the preferred RBA measure rose by 0.4 in the September quarter. Underlying inflation was steady at 1.6. Now that continues to fall outside of the RBA range, and it has been there for almost 4 years. So we're starting to see, obviously, that range 2 to 3% is what we're talking about. Now, what we do know also today is that the Treasurer, the Federal Treasurer, Josh Frydenberg, is going to be meeting with the Reserve Board to talk about that measure in terms of whether that's still appropriate. I think from Governor Lowe's point of view, he would say that it is still an appropriate means 2 to 3%. He, like all Federal Reserves around the world, are very, very scared of deflation and the impacts of what deflation can do for an economy. So to lower that expectation down to, say, a 1.5 to 3% would also mean that he's worried about that sort of deflationary element of that. So let's see how that comes out. We'll know in the next couple of days in terms of what that decision was and whether that target range will be adjusted accordingly. I want to move on to the housing market. This is obviously the biggest news story at the moment in terms of what's happening. We saw the CoreLogic data, so I'm going to spend a bit of time talking about the CoreLogic data. Overall, across all capital cities, we saw growth in the month of 1.4%. Now, that's the fastest monthly growth rate in 10 years, on the back really of tight supply, and it's the fourth consecutive month of growth since we bottomed out across the 8 capital cities in June of this year. Sydney was up 1.7% for the month, up 5% for the last quarter. Now, Sydney still is 10.4% below its previous peaks that we saw hit in mid-2017. Melbourne was up a staggering 2.3% for the month, which is the best return since 2009 post the GFC. Now, they are also up 5.5% for the quarter. Melbourne remains 5.8% below its previous peaks, which were sort of coming in the end of 2017 also. So that's the wrap up of our 2 biggest capital cities. I moved to Brisbane, up 0.8 for the month and 1.1% for the quarter. Adelaide up 0.4 and up 0.1% for the quarter. Perth a negative 0.4 of 1% to be down 1.7% for the quarter. Hobart up 0.9 and 1% overall for the quarter. Darwin up 0.3 but still negative 2.1% for the quarter. And Canberra 0.6 up and to be 2.4% up for the quarter. Of all of those, if we go to the annualised return, it leads like this. Hobart annually up 7.8, Canberra up 6.6. Then we go to Adelaide at number 3, up 3.6. Then Brisbane 3.3, Melbourne 2.1, Sydney 1%, and obviously we've got the 2 negative markets, Darwin down 2.3 and Perth for the annualised of 4.7%. So that's where we sit. If I take a view of what I see for 2020 with my crystal ball, I think we're going to see an improvement in regards to construction around the housing markets, but I think it's going to be a 2-tier market. I think what's going to happen is in the apartment market, we've still got a little bit of a crisis of confidence in regards to valuations and construction and quality and all of the other things that come into the apartment market, but are still quite a lot of apartments to come online after their completions over the course of the next year or 2. So I suspect the housing market is going to do very well. Freestanding detached housing, townhouses are probably going to outperform the unit market as we move into 2020, and that's a concern for some. Speaking of which, however, the building approvals data that came in last month, we did see a rise of 7.6% in September, which ended 3 months of consecutive declines. Now, that hasn't turned the overall market around. We are still down 19% from the peak of where we were 12 months ago. That's the annualised basis. And so we're certainly not out of the woods yet when it comes to that. We need a few more good months of approvals coming through, and I suspect we will get that. There's no doubt that the first home buyers are in the space. We do know that the federal government's deposit incentive will also play an important role there in getting them out and buying properties as well. So I do expect some spike there. I do expect we will start to see, with also the easing around APRA's controls and a little bit better borrowing power going on at the moment, that we'll probably see a bit more improvement in medium density and high density construction stuff going forward, but not at the peak levels that we did see in 2017, 2018. Housing credit, new lending for housing is back in the black. So where we're talking about there, that the RBA has definitely made some stimulus moves there. And the data for June to August saw 12% rebound, which reversed the 6% decline that we saw in housing credit for the first 5 months of the year. And that's in response to the uncertainty around the political environment at that time and leading into the May election, and also what's also unfolded around responsible lending and post-Royal Commission, and also again coming back to the APRA movements that we saw there. In terms of unemployment, it did tick lower, down to 5.2% in September, driven by a fall in the participation rate. So we created 14,700 jobs to the economy in September, and that's following on the 37,900 gain that we saw in August. Now that said, yesterday we saw ANZ jobs data come in, and there was another fall in October by 1%. That was following the 0.3% gain in September, but the trend is definitely down. Job ads have been down in trend terms by 0.3 month on month and 10.9% year on year. So that hasn't flowed into the unemployment rate, but that would be concerning to all of the Reserve Governor and his board, as well as obviously the broader economic outlook for the economy. Moving into the consumer spending side of things and consumer sentiment, Westpac Melbourne Institute Consumer Sentiment Index fell 5.5% to a reading of 92.8, and that's the lowest since July of 2015. So that's not good. So obviously there remains more pessimistic people on the back of the negative news cycles we're getting, and why are we dropping interest rates if the economy's in an okay position? So the mixed messages that we're seeing there, so that's obviously never good. In terms of it's good news for the borrowers out there, because obviously they're getting lower interest rates, but for those baby boomers who have got money stored in bank accounts and looking for interest returns, it's not very good for them in terms of what's going to be happening in that particular space. So we haven't seen any strong bounce in consumer sentiment, but I am keen to see what happens over the next 6 months in regards to, the wealth effect coming back in. I've talked about how the wealth effect basically made everyone put their hands in their pockets when house prices were falling. Now that those house prices are gaining momentum, what's going to happen over that Christmas New Year period? So the next 3 to 6 months is going to be a good indication in terms of what we see consumer sentiment doing, and we'll see that play out. In terms of retail spending, we did see the latest data come out yesterday again, and we saw a rise of 0.2 in September to August. Over the year, the September trend terms, retail sales were 2.4% higher than they were from 2018 September. And now, most economists were expecting a bigger bounce here, a bigger figure. That didn't come. Now, they were expecting that obviously on the back of the rate cuts and also the tax cuts and stimulus that was put in there. So that would be concerning again for the RBA. In terms of business confidence, the NAB monthly business survey showed that business sentiment remains soft in September. Business confidence fell 1% to 0, the lowest since March of last year. Now, positive news inside here, we did see the business condition index rising 1 point to be +2. Now, we want to see that more around +4, +5. That's when we start to see some good activity in terms of business in the economy. So more broadly speaking, in terms of my view in closing, it's likely that we will see another rate cut in February on the back of the current economic climate that we got here. That's well known. Most economists are predicting that. There is still a question mark around December and whether we will see something there. Obviously, the data that was released yesterday in regards to retail sales So we've still got to turn our attention more to the unemployment story. Those ANZ job numbers weren't great. So from that point of view, we'll see whether that starts to flow into the unemployment, which could mean there's an outside chance of the rate cut happening in December, which is a little Christmas bonus for those people who have borrowings. Not so great again for our baby boomers who rely on that income coming from that. Now, what I would be saying is the other big news that we want to be looking at, and the big data story that will transpire in December, is going to be the half year budget summary and whether we are in surplus or not. So my story there is around once we see that surplus coming in, then we know the federal government will score their political points that they want to score in terms of returning the budget to surplus, but then they can get on with the job of organising a stimulus package that will be rolled out in the early parts of 2020. My view on what that stimulus package will include are rate cuts, more personal rate cuts is going to be in there. The new start allowance will also be given an increase during that time. And you know, in terms of a crazy idea, I'd also love to see them announce something along the lines of, you know, building a couple of nuclear power plants, to bring our energy prices down. We need to go nuclear. It's a joke in terms of how much energy costs us in this country. I know that's wishful thinking, but I'll speak to you on that wishful thinking note next month.